if you look back at our tweets earlier, we were expecting a Santa Claus rally. We got that, which is technically the last 5 days of the prior year plus the first 2 days of the new year. What surprised the heck out of us was how much the market continued to move up, including through earnings, despite the fact that earnings came down. And I heard your conversations earlier, and yeah, if you look at a basket of unprofitable tech names, the most shorted tech names and the meme stocks, this year they're up between 17 to 27% through yesterday. Last year, that same grouping of names was down 52% to 64%. So, you could buy pretty much anything this year and be making money. Now, by the way, that's why people talk about the January effect, where the most shorted names go up to start the year, or call it the dogs of the Dow theory, which I'm sure many of your viewers have heard about as well, right? Where you buy the worst names from the prior year and, they outperform. So a lot of this is kind of what you'd expect. The magnitude is obviously pretty high, but don't forget, think about last year. Between June through August of last year, the S&P had a 17% rally. You had a lot of people come on talking about, well, technically, you've had a breadth thrust, and the S&P has had, a lot of constituents above their, 20-day moving averages, et cetera, and, it'll never go to new lows, and it did. So I look at this year, and if you're thinking about fundamentally, which is ultimately the only two things that matter are earnings and the multiple you put on earnings. Earnings went down during the earnings season for all big cap tech names, and then the multiple went up. And I think by the time you get to the second half of the year, you're going to see earnings go even lower and multiples start to go lower as well, as we figure out that the Fed's not going to cut and inflation's higher than we expected.
So, Dan, it sounds like you don't think that this rally is going to last throughout this year. I know you're calling it a low-quality rally, but let me pose to you that it's broader than that, broader than unprofitable tech and short squeezes. The semi-ETF, SMH, is up 22% year to date. You also have mega cap stocks moving higher, and all of this while bond yields are moving higher too.
Well, you got to remember, right? Bond yields went down a lot to start the year, and people have gotten very optimistic. And the way I think about it is a lot of the things that are driving the market, right, so far in the first half of the year, you're not going to be able to disprove until the back half of the year. And what I mean by that is right now, if you look at the Fed funds futures, they've got rate cuts starting in the middle of the year. So you're going to kind of have to get closer to that for people to go, you know what? Services inflation, excluding housing, which is 55% of core PCE, that's still going to remain higher than expected because you got 5 million more job openings than people unemployed. And, you talk about the number of people getting fired in tech, that's great, but that doesn't cover the broader economy where 75% of jobs are in SMB. You've got retail where you've got $1.5 trillion in excess savings still. But remember, that number was $2.5 trillion at the peak. It's gone down to $1.5 trillion as consumers burn through that. That's going to be all gone by mid-year. So the way I'm kind of thinking about it is you're going to get to mid-year, and some of these things that are supporting the market, they're going to continue. They're going to start disappearing, and then you're going to have to deal with, okay, now what happens? Because I think the Fed, quite honestly, is going to get closer to 6% before they stop raising.
So, Dan, this kind of reminds me of one of those parties in high school where, based on the mix of who showed up, you could tell how it was going to end. It's like, okay, the cops are going to break this one up probably by midnight, right? So, but when is midnight? Because you can miss a lot of market action if you put a short on too soon or if you stay in cash too long. So what should people do in this environment? Do they wait until that mid-year point or close to it that you're talking about? Or do you look at some of the things that are rallying now and you say, okay, well, maybe it's time to short them here?
Well, I look at what is rallying. So I go, all right, if the market is going up, and today is another example, right? A lot of those baskets we talked about, they're up another couple of percent today. You look at, David Faber was talking about Coinbase and left it to you guys to figure out why it's up so much today. It's a similar thing, right? You can look at Affirm results last night, which were horrific, and the stock's up a fair bit today. And so when I see that driving the market versus, sort of the bellwether, whether it's Apple or Google or Microsoft, et cetera, and those are the ones sort of leading things higher on, hopefully, fundamentals that look like they're stabilizing, which they clearly are not. then that gives me more conviction that this thing has actual legs. When I see what's driving it, I go, okay, this doesn't have a lot of legs. I look at the inflation metrics that came out yesterday, which were, at best, okay. And I go, all right, I'm starting to add to my shorts. My shorts have gone from, nearly nothing in my portfolio late last year, early this year, to now they're up to 50-60% of the portfolio, and just, a little bit smaller than the number of longs I have in the portfolio. We're obviously a hedge fund, so we have a little bit of leverage. So for me, I kind of look at this and I go, I have areas I like, and I think investors should own some of those. So reopening plays to China. Some of the commodities have come in this rotation, right? Commodities did well last year. They've gotten punished to start this year to some extent. We own things in oil, copper, aluminum, natural gas, which has gotten absolutely crushed. And we view the fact that the world's biggest buyer of a lot of these commodities is coming back to the market after 3 years of a lockdown. That's interesting to us. We own Facebook, which we've talked about before, which is obviously some offense in terms of a tech name that, we thought fundamentals were fine. Their spending was out of control, but they've obviously reined that in. And so it's kind of this mix. And then we own healthcare, which we've been adding to, because, again, people have rotated out of healthcare, which did well last year. And, that's gone down, and they moved that money into these areas that we've talked about. So I think you want a nice mix of both right now in your portfolio. And we own travel names like United Airlines, Expedia, Make My Trip in India. Those are things that we like as well, again, off of, China reopening, and they like to travel. And we've seen that in the US.